Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 419 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about investing, and specifically investing during uncertainty. If you haven't noticed lately in financial markets, it has not been all hunky-dory, right? It has not been the most fun to be an investor and watch your savings just dwindle away. The good news is that this isn't the first time that this has happened. The good news is that we've lived through things much worse. And the even better news is that this may just be another opportunity for us to buy good companies, buy good investments at low prices. And that's what we want, right? Buy low, sell high. And hopefully that's what we can do and not just get so freaked out that we fail to invest properly at all. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, listen, I understand that investing can be scary. Okay, I understand even more that investing can be scary when you've been through some hard financial times, right? If you've dug yourself out of large amounts of debt, or if you didn't used to have much money at all, now you have enough money to invest and enough money to save for your future, you don't want to see that money go away. You don't want to see that money decrease in value, right? So it's hard to watch market turmoil occur. And it's hard to understand as a novice investor why it needs to occur at all, right? But we are seeing it, and we have seen it quite recently, right? Between an S&P 500 that's well into a correction, or, a NASDAQ that's 100% in a bear market. And, some of those stocks have taken an absolute beating, right? Whether it's either one of those or just individual names that have been just torn to pieces or whatever in the recent past, understanding what's going on and then understanding what to do on the other side of uncertainty is tough, right? Market turmoil can put even the most confident investors on edge. Look, I began investing just systematically, right? When I got out of my master's degree program, and this is about 4 years ago or so, a little over 4 years ago, right? And it was a little scary, right? But, markets were going up, everything felt good, everything was great. And then, about 2 years into my investing journey, what happens? You see the coronavirus pandemic hit. Now, I see myself as a pretty confident investor. I think I have a relatively high risk tolerance, but I think a lot of that comes from my understanding and my learning about financial markets, my education about financial markets, all those types of things. Now, that being said, it does not make you, question your decisions any less when a major market correction or a bear market or big crash like the coronavirus crash occurs, right? Nerves are totally understandable, and it's tough to stomach the wild drops in investment portfolio values when the stock market takes a hard, sudden, and seemingly prolonged hit, right? And that's just what we're living through right now, right? We're living through this more prolonged hit that is being taken by markets, right? We'll see some up days, but for the most part, the market is bleeding downward, right? You just go back to the beginning of the year. The beginning of the year, the S&P 500 was sitting just shy of 4,800. Now you see the S&P 500 as of Tuesday's close being, 4,170. So, 13% down just year to date. It has been a pretty slow bleed. And don't get me wrong, you've seen, some pushes upward, right? Between January 27th and February 2nd, there was a 6% increase in the value of the S&P. I mean, as recently as February 23rd to February 25th, there was almost a 4% increase in the index. But overall, there's just been this march downward by the major indexes, and that can be disheartening, right? That can be frustrating to deal with. When stock prices are on the rise, many don't need much convincing to stay invested, right? We saw that with the meme stock craze. We saw that with crypto. We've seen all this, right? We saw that with ARK Innovation, that people are not afraid to be invested and fully invested and putting money to work in things that may even be quite volatile when the volatility is not showing up, or when all of the major moves are to the upside and not to the downside. One of the most important things that we can do in these times, though, is to stay calm, avoid making emotional decisions. Of course, that is easier said than done. While what's happening in the stock market is largely out of our control, what we can control is how we react. Right? I think that's the biggest thing that I want to get across in today's episode, is that we can only control ourselves. Right? We can't control what a company does. We can't control what an index does. We can't control what country invades what country. We can't control the Federal Reserve. We can't control any of that, right? But what we can control is the decisions that we make and our temperament in making those decisions. And we have to live with the decisions that we make, right? So make the ones that you are willing to live with investing-wise over a long period of time. Now, risk is an inherent part of investing, and it's something that you cannot completely eliminate, but you can manage, okay? So the first thing I want to tell you that you can do in times of uncertainty and in times of just volatility in financial markets is to understand the basics of investing and your tolerance for risk. I think this is absolutely huge, right? Like I said, a lot of my confidence in investing comes from my understanding of the investment world. Right? So if you understand the basics, you understand how investing works and why you're going to make money over a long period of time, and what you can be invested in and what this represents and what an ETF is and what a mutual fund is. The more that you understand these types of things, the more likely you're going to ride out the storms of volatility and uncertainty, and the more likely you're going to continue putting money to work over long periods of time and making a lot of money over a long period of time. Now, a basic understanding of investing and your risk tolerance can do much to help you maintain a steady head and steady hands when stock prices go for a stomach-dropping ride. Those who are new to investing may get jittery during a market downturn, and this is why having a solid grasp on the basics of investing and how the stock market works can help calm nerves and boost confidence. For example, if you have a strong foundational knowledge of the stock market, you would know that volatility is inevitable, but it's also important to stay invested for the long term because historically speaking, the value of the stock market has trended upward over time. And this is something I'll reiterate here later, but we know, and we've talked about before, how time in the market is more valuable than timing the market, right? Meaning the more time you spend invested is going to be far more valuable to you than trying to get in, get out, and get the best prices all the time, because it's very difficult to do. Now, understanding your tolerance for risk is absolutely huge as well. And I talk about this all the time because I think too many people jump into investing thinking that they can take it, right? Thinking that they can take the drops, or not worrying about the drops because things look so good at the moment, right? So people don't worry so much about what may happen when things turn, and what may happen to their portfolio when things turn, and how they may react to those types of things occurring, right? There's like this denial that your portfolio will ever go down in a meaningful way, right? And so those people tend to have risk tolerances that are off, right? They tend to have risk tolerances that are not in alignment with the things that they are invested in. Most people reach more when it comes to risk. They reach more when it comes to the risk that they take than they probably should. And this is a problem because then when volatility hits, when something negative is occurring in financial markets, then you're stuck in a place where you're over invested in risk assets. And yet one of the worst things you can do with those risk assets at that time is to divest from those assets, right? So you kind of have to stick it out if you want to maintain returns in something that might not be that good for you, right? Which is a big problem. Okay, so you want to be invested with the proper risk tolerance taking into account, because if you can handle the amount of negative that could occur with a particular portfolio or a particular allocation, then you know that you'll be comfortable and that you'll do the right things. But if you take on too much risk and then you realize that you can't take it at the time, I mean, the worst can happen, and you can just lock in all of those losses and lock in all of that negativity by selling when those high risk assets end up going downward. Right, a key part of investing involves the proper balancing of potential risk against potential reward, and having an investment plan or strategy that reflects your risk tolerance could help you resist the urge to react emotionally during a downturn, giving you the confidence to stay in the game and ride out the turbulence. Look, that's what I want for all of us, is I want all of us to understand who we are as investors, understand investing at least a basic level, enough to not get scared out of the market, and then to stay in the game and ride out the turbulence and continue investing over a long period of time, right? So that's the first thing. The first thing that I think you can do in times of uncertainty: understand the basics and your risk tolerance, and invest accordingly, okay? Now, the second thing I think you can do is review your investments, right? You need to make sure that you are properly diversified, right? That you aren't taking too much individual risk anywhere. And again, that this aligns with the risk tolerance that you have for your own investment portfolio. Now, risk is an inherent part of investing. We know this, right? Without risk, there is no return, right? And it's something that you cannot completely eliminate, but risk can be managed with certain investment strategies, right? Diversification is one way to help protect your portfolio from the ups and downs of the market. While diversification as a strategy doesn't guarantee against losses, it can help limit your exposure to certain investment risks. And the broadest of examples that you can give here is the difference between investing in one stock and investing in many stocks, right? So let's just give the example. We'll start with the S&P 500. Like I said, through Tuesday's close year to date, the S&P 500 is down 13.07%. But let's just take one company out of that particular index, right? So you can just take out one company, and let's just take out Tesla, right? So let's say you only owned Tesla. Well, year to date, you would be down 31.29%. And why is that? Because you're taking firm-specific risk for Tesla, right? Their stock is down 31.29%. But if you add Tesla to this big basket of stocks that is the S&P 500, then what? Then you're looking at having a more diversified portfolio to where you have some winners along with bigger losers like Tesla. And then what are you left with? You're left with still a loss, but not near as bad a loss as just being invested in one stock. So diversification is an important thing to do. Now, by diversifying your investments, where you invest in a mix of assets, stocks, bonds, ETFs, whatever, your portfolio can be better prepared to withstand certain market shocks. The idea is that if one asset takes a hard hit, other parts of your portfolio may help cushion that blow. So, for example, in the S&P 500, what may cushion the blow for Tesla? Some of these value stocks, right? Some of the stocks that have been going up recently, the Berkshire Hathaways of the world, right? That are making returns in these bad times when a stock like Tesla is getting hit hard. So you'll see that there's, kind of this offsetting impact that some of these companies can have with one another. And that is what diversification is going to allow for you. And this decreases your risk, right? It decreases the volatility on the upside or the downside of your portfolio. And that's just the key, right? Of course, are you going to give up some returns to the upside potentially? Sure. But are you definitely going to give up some negative returns to the downside? Of course. And that's what most people want to do if they can still make a reliable rate of return over a long period of time. Now, you may also want to check and see if you need to rebalance your portfolio. And I think this would have been a very important thing to do last year. And it may still be an important thing to do for some of you this year. Okay. So many people had such a growth stock heavy portfolio that portfolio starts getting out of whack, right? Because those stocks continue going up and up, and value stocks really aren't doing anything, and bonds really aren't doing anything. And so those, assets that are high growth are just up, 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 right? And so then a large portion of your portfolio becomes growth stocks, maybe a larger portfolio than you are comfortable with your risk tolerance. And so what you ultimately would need to do is rebalance your portfolio. Rebalance your portfolio to an allocation that you are more comfortable with your risk tolerance, right? And so take some of those growth stocks, sell some of them, buy some more value-oriented things, buy bonds as an allocation, buy other things that are going to add to your asset mix and allow you to have a proper asset allocation that is commensurate with the risk level that you have in your own investing life. Now, failing to do this is going to put you in a position where you are very apt to take some major losses or freak out because you're taking too much risk in a particular area that you weren't prepared to take that type of risk. Now, another question that you might ask yourself is whether your particular mix of assets, your asset allocation, still makes sense for your financial goals. So, for instance, as you get closer to retirement, you may be more risk averse, opting to invest in more bonds rather than stocks. And the bottom line is preparing your investment portfolio with certain risks in mind could ease some concerns when the stock market hits a bump down the road. Okay, so just knowing where you're at, understanding that you need to be diversified, understanding when you may need the money in your investments, and just understanding what you hold and what you should hold based on your risk tolerance is vital when it comes to being a good investor in uncertain markets. Now, the third thing I can tell you about investing in uncertain markets is that you need to take the long view. Falling stock prices may present an opportunity for us all. It's never easy to watch stock prices and portfolio values fall, and some inexperienced investors might be tempted to make a quick exit from the market, selling at just some loss to avoid further pain. When it comes to investing, however, it's important to take the long view and not let the short-term market volatility distract you from your long-term goals. By staying in the game, you're generally in a good position to reach your long-term investment goals. This is particularly important for those with a long time horizon to keep in mind, as they have more time to ride out the ups and downs of the market, right? And this goes back to time in the market is more valuable than timing the market, right? So we need to stay invested over long periods of time because, I'm going to use some extreme examples, but let's just say that you looked at the NASDAQ, right? And we know that the NASDAQ index is more volatile than the S&P 500 because it holds more technology, growth, smaller firms, things like that, right? And so you look at the NASDAQ, and let's just go back to the dot-com bubble. The dot-com bubble was very heavily concentrated within the NASDAQ, right? There was a bunch of tech firms, a bunch of firms that, if they had .com in their name, they were going to be on the up and up. Now, March 10th of 2000, the NASDAQ is at 5,048, right? That's the value of the NASDAQ index, okay? By, March 15th of 2002, March 15th, 2002, the NASDAQ would be down 62.99% from March 10th, 2000, and it would be down over 3,000 points, right? So it was down at 1868.30, okay? But if you just said, hey, forget growth stocks, I'm never going to invest in growth stocks again from there, then what'd you miss out on? Well, it's been almost exactly 20 years since that bottom. What have we found? Well, in that last 20 years, it's been the NASDAQ has made 584.87% as far as returns go. And so let's just compare real quickly the NASDAQ with the S&P. Even though the NASDAQ took that major fall, right, took that major decline, if you just overlaid the NASDAQ and the S&P since 1982, the NASDAQ has made compounded returns that give you over a 7,349% return relative to the S&P, which has provided a 3,670% return. Now, does that mean you need to put everything in the NASDAQ? No, but it gives you a very clear picture of what? more risk, more return over long periods of time in diversified assets. But if you were to have just sold off and just gone along with the downward pressure that was occurring during the dot-com bubble, then you would have never seen the amazing uptrend that has occurred ever since. Okay. Now, if stocks are already a part of your retirement plan, your IRA, 401k, by simply maintaining or increasing your contributions, you're in a position to take advantage of lower stock prices. That's because your regular contributions help you to purchase additional shares automatically. Right? To some folks, it might seem irrational to put more money into a shaky market, but there's good potential for it to pay off in the long run if the market recovers and if stock values climb again. Now, a down market can be a good time to buy all types of things, right? You could be buying individual names, right? If you pick individual stocks that have been beaten down, that can be a dangerous game too, because you don't want to get caught up in, especially growth names that are down quite a lot. You don't want to get caught up in trying to buy them too much, and then it ends up that they're just going to continue lower. But it's a good time to buy high quality names that have been hit hard by just a bad market. And it's also a good time to just buy indexes, right? Buy an ETF, right? That's tracking the S&P or the total stock market or whatever, right? Or that tracks growth stocks, and it over a long period of time will pay off for you. And so if you can find indexes that are down 10, 15, 20%, those are going to be fantastic values and fantastic abilities to buy based on historical evidence. Now, before going on a buying spree on your own, it's good to check in with an investment advisor if you have one. And when markets are volatile due to economic uncertainties, the potential risk is that stock prices might continue to drop, right? So picking individual names is far more dangerous than the idea of just adding to your diversified assets and doing so with that same dollar cost averaging type idea, where you're putting the same amount of money in every single month, every single paycheck, and you end up buying things at a lower price, which is beneficial to you as an investor. Now, the fourth thing, if you're investing through uncertain times, that I can suggest to you is to consult with some financial professional. Now, be careful here, because I'm not suggesting that you go and just give your money to a financial, professional financial advisor, investment advisor, in order for them to just, invest your money however they see fit. That's not what I'm saying, right? But sometimes, especially if you're new to investing, if you can get somebody who has some experience, and this is their field, this is their profession, you can talk to them and get some of their advice, then it can be extremely valuable, right? When things get dicey with the stock market, helps to know that you don't have to weather the turmoil on your own. It's normal to feel anxious, especially since it's almost impossible to tune out the scary headlines and endless news cycles on television. This is why checking in with a financial professional during uncertain times is a good idea. Financial experts can serve as a shelter in the storm, helping you to tune out all the noise and empowering you with options. They may review your investments with you and discuss potential actions that you may consider taking. In some ways, volatility in the market is a good reminder for some investors to revisit their investment strategy and correct any imbalances if necessary. And I think this is so true, right? If nothing else, a good correction or a good bear market is a good reason to get your investment house in order and to stop fooling around with whatever you're fooling around with, and follow a plan and look towards the long term and buy things at low prices and just keep buying and buying and buying into oblivion. Now, financial experts could also help to give you some historical perspective, which I'm about to do here as well. So let's just take a look and think for a moment about recessions, right? And we're not currently in a recession, even though we're taking a pretty hard hit in the stock market. We're not in a recession currently, but recessions are times when stock prices can get very depressed. And so let's just think about, so what do you expect the S&P 500's returns to be throughout a recession, 6 months before recession, 12 months before recession, and then 6 months after and 12 months after, right? And if you looked at these numbers, I think you would be surprised. So if you look at all the recessions since the 70s, right? 73 to 75, that recession, 18% was the loss of the S&P 500. January 1980 to July 1980, there was a 16.4% increase. July 81 to November 82, there was a 14.5% increase. July 90 through March 91, there was a 7.6% increase. March 01 to November 01, 7.2% loss. December 07 to June 09, a 35.5% loss. And then February 20 to April 20 was a 9.3% loss. So on average, we're talking a 4.5% loss during recessions. Now, what about the year before for the S&P 500? A year before, 12 months before the recession, you're looking at 11% gains, right? 11% gains. You go 6 months before, that average goes down to 0.3%. But you go 6 months after, 9.6% gains on average. And then the average 12 months out after a recession is 17.4% return. So ultimately, what's this tell you? This tells you that you may take losses when negative things occur. You may take losses when the economy's not doing well. You may take losses, when something out of your control is occurring. But you keep buying, you keep buying, you keep buying, because almost exclusively you are going to make positive returns over time. And ultimately, you can make some very, very high positive returns coming out of something like a recession, right? So I just want you to be encouraged. I want you to be encouraged at the fact that if you feel uncertain about your investment portfolio right now, you are not the only one, right? If you feel like, things are going awry and you can't control them, I promise you are not the only one. If you worry about Russia, Ukraine, if you worry about inflation, if you worry about any of the things that could end up impacting your asset prices, then again, you are not alone, okay? I think about the same things. I have some worries about the same things, but guess what? I am always going to continue investing. I'm going to buy and buy and buy and buy until the cows come home. And I'm going to continue to invest. And ultimately, that's going to be most beneficial over the long term. Sometimes in your investing life, you simply have to put your head down, make sure you're doing the right things, and just continue on. Or even with more conviction, putting your head down, making sure you're doing the right things, and then leaning in a little further, putting more money to work, being more diligent about your investments, and becoming more knowledgeable about what's going on with your investments. It's only going to benefit you. It's only going to benefit you to learn about your investment life. It's only going to benefit you to learn more about being a good investor, because ultimately, very few of us, not saying none of us, but very few of us are going to become rich via income, right? Most people are going to become wealthy via their ability to invest and grow their money over long periods of time. And if you can't follow, simple investment principles, then this is not going to be you, right? If you can't, keep a cool head, if you don't have the proper risk tolerance set up in your investments, if you don't continue investing even in down times, or even more, especially in down times, then this is not likely to be you, right? These tips, these things are not just things to make you feel good and things to bridge the gap. These are things that will 100% help lead you to building wealth over a long period of time, which is what I hope we all can ultimately do in our investment lives, right? So the 4 things, again, that I really focused on here, right? Understand the basics of investing and your tolerance for risk. Review your investments, diversification as a risk management strategy. Then take the long view when it comes to investing. Falling stock prices may present an opportunity to buy. And then consulting with a financial professional if you need someone on your side, right? So remember all these things, and hopefully all these things help you to become a better investor, to be more thoughtful when things seem, uncertain in financial markets. I'm always here for you to help push you through and to help keep you on the right track when it comes to your investing life. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.